Welcome to the Capital News. I am your host, Alex Karitis. Today is April 18th, 2019. Thank you so much for joining me. I hope everyone is doing well out there. I'm going to keep this one a little bit more brief today because hopefully for everybody it's a nice long Easter weekend for you. So I'll keep this brief. We're going to talk about the stock market news of the day. The S&P closed up 4.5 points. The Dow was up 110. The NASDAQ closed up 2 points. And the Russell 2000, the small cap index, closed down about 2 points for the day. Oil remains at $64 a barrel. Gold is now at $1,277 an ounce, and silver remains at $14.97 an ounce. On the 10-year U.S. Treasury, we had a decrease in the yield by 1.23% and now sit at 2.56% on the 10-year U.S. Treasury. The VIX was also down 4 percentage points today and settled at $12.09. A couple things I do want to talk about as far as what is likely to be the competing forces, perhaps, at least ideologically, moving forward with these markets, comes from sort of differing opinions from a couple market giants. So one of those market leaders, obviously, is Ray Dalio of Bridgewater Associates. We've been discussing Ray Dalio and Bridgewater Associates for the past week or so. We read an article yesterday here at the Capital News in regards to Bridgewater Associates, a recent report that they submitted that was calling for peak profits within the United States and was anticipating stock prices and equities, obviously, to suffer quite significantly, perhaps by as much as 40%. And again, that analysis is in alignment with what we have been saying here at the Capital News for the past couple months since this podcast has been on air. So it's nice to feel at least somewhat vindicated from the world's largest hedge fund in the world, $160 billion in assets under management. So it's nice to at least be on the same page with Mr. Dalio and company in that regards, because we were saying, folks, here, I'm anticipating at least a pullback to 2016 levels, which would correspond to about a 40% decline. I think it could go further in the event of a panic or some sort of catalyst and a domino effect taking place. But they were simply just looking at U.S. profit margins peaking and that being a catalyst in and of itself, at least according to Bridgewater Associates. Now, the other theory out there that could take place came from Larry Fink, the CEO of BlackRock. We reported BlackRock's earnings earlier in the week. They are an investment firm, sort of like a Fidelity or a Vanguard. They have $6.5 trillion in assets under management. And what Mr. Fink and BlackRock seem to think that is at least a possibility, and this is a possibility in my mind as well, that what could take place over the next few months or remaining months in 2019 is what is called a melt up. Not a meltdown, but a melt up. And the argument here is that there is a lot of cash that remains sitting on the sidelines. So despite the fact that we've had a V-shaped recovery since the beginning of this year, late last year, there's still more to go because there's so much cash sitting it out. Now, this is quite possible. We've also known that there's been a quote-unquote flight to safety in some corporate bonds, even some high-yield corporate bonds. There's been some flight to safeties in sovereign debt, so that's government debt. Is that money going to come out of those sectors, out of the bond market, out of simply sitting in cash, and is it going to look for a higher yield with equities? That's quite the possibility. You have to understand, on every trade, somebody's buying and somebody's selling. And I can assure you that there are a lot of smart people on both sides of the trade. You have a lot of brilliant minds that exist within BlackRock. You don't accumulate $6.5 trillion by not doing something right. And you don't accumulate $160 billion and be the world's largest hedge fund by not doing something right either. So obviously timing has something to do with it. But I don't think that the likes of Bridgewater Associates would release that report if they weren't expecting that to take place in the relatively near future. Relatively near future being probably 6 to 12 months. BlackRock, on the other hand, that's something that could happen more overnight-ish, if you will. That's something that could happen more quickly and probably within the 6-month range. Obviously, like I said, the remainder of 2019. It's anybody's guess. It's anybody's guess. Obviously, here at the Capital News, we're more inclined to think, at least long-term, 6 months, a year, 18 months, that this market will cave in. It will collapse. This isn't to frighten anybody. This isn't to be a doom and gloomer. We're not doom and gloomers here at the Capital News. We're simply people who look at the data. We put this economic puzzle together by looking at piece by piece, giving different weights and different, importance to different pieces. And the picture that it's starting to paint for us is that it's not a good one. And this is global. Here is what has taken place since the fourth quarter of 2018. We had a president of the United States tweet out, "Buy the dips." The market rallied 1,000 points. He sends his Treasury Secretary to meet the plunge protection team. And since then, in addition to the Federal Reserve doing a policy 180, along with other central banks doing policy 180s, we've had a V-shaped recovery. This isn't fundamental news. A president tweeting, sending out a plunge protection team, sounds kind of fixed to me, doesn't it? A Federal Reserve that doesn't know its ass from its elbow, just completely changing its mind because the crybabies on Wall Street threw a hissy fit. And they said, "Oh, no, you can't take away the punch bowl. You can't take away that. We need it. We need our fix." And Jay Powell and the Federal Reserve, they said, "Okay, no problem. My bad. Didn't mean to do it. Here you go. Here's your drugs. Get your high on again. Get back to normal, quote unquote normal." And this is why we have a V-shaped recovery. There isn't anything fundamental here going on. GDP wasn't even 3%. It was 2.9. It was supposed to eclipse that. And of course, the president is blaming the Federal Reserve. He takes no responsibility. He takes responsibility for the stock market, wants to take responsibility for the economy, but it didn't hit 3%. So it's the Federal Reserve's fault. According to the recent tweets that we've been focusing on, and even official statements coming from the White House itself, according to the president, according to the White House, if the Fed had not messed around in 2017 and 2018 increasing interest rates as much as they did, the president and the White House argue that GDP would have been above 4%. I don't happen to agree with that. Is it possible? Sure, it's possible, but at what expense? That's the whole question. That's the question. That's what the Capital News is focused on. It's not the political propaganda that comes from the Democrats and the Republicans. It's not the economic and financial propaganda that comes from a lot of the financial mainstream media and the Federal Reserve. We cut through all that bull. We look at the data, the stuff that obviously some of it is skewed. Some of it you have seasonality adjustments. These are just arguments and excuses. That's why we don't focus on any one number here. That's why I say this is an economic puzzle, and you have to look at it piece by piece, and you have to know which pieces are more valuable, have more color, have more flavor, that deserve a higher weight when you look at them and when you analyze them. And that's what we do here. That's why we have the discussions. That's why I tell you about the monetary base. That's why I tell you overlay the monetary base with the Wilshire Stock Index. That's why we talk about corporate debt. Whether it's investment grade, whether it's high grade, whether we're talking about consumer and industrial loans, whether we're talking about leveraged loans, whether we're talking about the shadow banking industry, that's important stuff. And now when you have it against the backdrop of two brilliant financiers and investors out there, Larry Fink of BlackRock, Ray Dalio of Bridgewater Associates, one saying there could be a melt-up, the other one saying, well, you know what, U.S. profit margins have probably peaked, expect a 40% decline. And I think if you're going to come out and say 40% decline, you probably mean it's going to be even worse. But you don't want to over-scare the markets or do anything like that. Now, of course, the markets haven't reacted negatively to that, nor have they melted up following these statements. Right now, the markets are pretty much in a holding period, a holding pattern right now. To me, these are markets on edge because there ain't any good data coming out. There just isn't that warrants some sort of catalyst to the upside. Now, I know, and so do you, that these markets want to go higher, that they want to retouch their all-time highs, if not break through them. And when you look at the S&P, and when you look at the Dow, and when you look at the NASDAQ, we're not that far away. Not at all. We could do it, next week. There's no question. We could touch all-time highs. We could break through them next week. It is possible. The Russell 2000, that's a different story. That's technically still in correction territory, being down 10% from its all-time highs. But again, we had that conversation yesterday. Is that sort of a canary in the coal mine? Because the small caps, they don't have a lot of international exposure. That's national exposure to the United States. And if everything was rosy and peachy, unicorns and butterflies and rainbows, well then why aren't the small caps rallying? Why? That's a legitimate question. Is it because things aren't as good as we're being told? If you follow this podcast, you know the answer is a resounding yes. But that doesn't mean that we aren't living in a world of financial odds, which we are. And that doesn't mean that the Russell 2000, along with the other indexes, could make all-time highs again. Because there is a lot of cash sitting on the sidelines. A lot of people have missed out on this rally. Are people now going to come in at all-time highs? That's the psychology. Again, from my standpoint, the risk-reward just isn't there for me. It just isn't. I have cash sitting on the sidelines. I have some of this money long the market. I have some money put there that's shorting this market. And I can sit and wait until that day happens. And if it's a loss, it's just a paper loss. I have the stomach for the volatility. I have cash built up waiting for the sell of a lifetime that will happen over the course of a year or two. I'm willing to wait 2 years. If it goes out any longer, this whole thing it's completely fixed. There ain't no ifs, ands, or buts about it with me. You just got to throw your hands up and say, my goodness, that's all it is. Central banks print money and these stock markets just keep going up. That's it. There's no fundamentals. If that's it, who wants to even be a part of that system? It's not worth it, because at what expense? It's the largest wealth transfer in the history of mankind as it is. You just want to keep continuing this? Just let this live in perpetuity? Let this income inequality just continue? Because it's not benefiting middle-class Americans at all. Look at some of the housing data. Look how expensive the average house price is. Look how expensive the median house price is. And then look at wages and incomes. This is ridiculous. This is pretty much worse than what it was during 08 and 09 in the lead up to it. You can't make this stuff up. And supposedly everything's fine. We know it's not. We know that 7 million Americans are 90 days plus past due on their auto loans. We know that there are rising delinquencies when it comes to the student loan market, which, for your information, is now $1.6 trillion and counting. $1.6 trillion. We have rising defaults on credit cards. We have, it's one after the other. It's one after the other. We have, what's the other big one that's been coming out now? We have more and more retail stores closing, and there are some estimates that there might be as many as 12,000 retail stores closing this year. Now, that's not net. I think right now it's close to 6,000 that have announced that they are going to be closing. And I believe there's about 2,000 to 2,500 that claim that they'll be opening. So net, you're talking a few thousand that are closing. But for the entire year, there's estimates are 12,000 stores will be closing. That's not good. And you can't blame all of that on Amazon. The consumer is tapped out. They can tell you all day, every day, till they're blue in the face that there is no inflation. That's nonsense. That's nonsense. If that was the case, then everybody would be spending money. But then you have to look at the velocity of money, and that's extremely low. So this is ridiculous that anybody takes this seriously when it comes to inflation metrics. So that is always something that we're going to focus on here, because we know the truth. We know that it isn't 1.5%, 2%. We know it's much, much higher than that. If it wasn't, this economy would be doing a lot better. But it's just squeezing the life out of the middle class in this country. And that's what it is. And then you have record bank profits that we've been reporting on. Again, I think a lot of that was at the expense of some layoffs and some other internal moves that were taking place. But I happen to agree with Ray Dalio and company on that these profit margins are peaking. And now you have pretty much nowhere but down to go. Now, I think for the first quarter, So far, we might be dodging an earnings recession, but we're going to see what happens, obviously, over Q2, Q3, and Q4. But we're still waiting for a trade deal. If not with the Chinese, then at least the European Union. But there's no sight, no end in sight for either of those. In fact, we haven't heard much on either front. So what does that tell us? I mean, what's going on here? Again, there's a whole host of things I would like to be discussing. Same thing with how I was just signing off with the geopolitical report saying, look, there's a whole bunch of issues I want to talk about, but Bob Mueller, we got to talk about this Bob Mueller report. Got to keep talking about it. Have to keep bringing up what the Democrats are doing to this president because it's important. It's nonsense, but it's important because what are they going to do? Are they actually going to try to impeach the president of the United States? What's going to take place? And you have to remember, folks, the president said what can destroy this economic miracle? Endless wars, political division, and endless investigations. Well, he's already dancing. He's already starting to blame the Federal Reserve. These Democrats are already set to attack the president and continue their investigations from north, south, east, and west. So if this economy does roll over, if this stock market does roll over, he's got his outs. I told you he was going to be able to do this. I told you he was going to do it. So he will continue to blame the Fed, and he will also blame the Democrats because he'll say, look, the stock markets have made all-time highs under Trump. The markets love Trump. They love me. They love me. They love me. You guys, I told you this was nonsense. It was a witch hunt. There was never any collusion. And if you investigate me in this campaign, in this administration, the markets are going to sell off. And if they do, he's got them dead to rights, and he's going to blame them. And his base is going to trust him. I mean, got to give the guy credit because he can either take credit when it keeps going up. He says, this is all the policies that I've put through. And if it goes down, he's going to blame the Fed, and he's going to blame the Democrats. It's poor leadership, but it might make for interesting politics, and he will be able to maneuver at least with his base. So I'm going to end it there for today. You guys enjoy your long Easter weekend. I wish you all a very happy Easter with your friends and family, and I will catch you here back on Monday. Thanks for joining me, ladies and gentlemen. It's been a pleasure having you as always. Please like, share, subscribe, get the word out. Leave your comments. We'd love to hear from you. This is the Capital News. I am Alex Kreitis. Godspeed.